Thank you, John, and good morning, ladies and gentlemen. Over the course of the next 30 minutes, my colleague Nico Buchholz and I will share with you the progress of our transformation plan. Let me first start by putting the transformation plan into context. Alain and John talked about a 5-year turnaround at Bombardier that consisted basically of 3 phases. The de-risk phase, which is clearly behind us, the build phase, and the deliver. The operational transformation is a key pillar of the build phase and is delivering against and built into the 5-year financial plan. Let me start first a little bit with what I said to you last year. Last year, as I stood before you, I had mentioned to you we'd created a transformation office at corporate underneath my leadership and satellite offices in each one of our 4 business segments. The teams had done a bottom-up initiative, and we had come up with a plan, and the plan was basically to deliver $2.5 to $3 billion of incremental cumulative free cash flow across the 5 years between the end of 2015 and 2020. And this is what we baked into our financial plan. I'm very happy to say that after the first year of our transformation, which arguably is kind of a transitional, challenging kind of year, our transformation teams and initiative owners have delivered. And they've delivered, I think, to a great extent. Year 1, $700 million of free cash flow has been liberated from the transformation. If we take a look at the $700 million, it breaks down to 2 components. $500 million worth of free cash flow released against working capital, which is really driven by inventory initiatives. And $200 million of free cash flow driven by cost savings initiatives that have given us recurrent EBIT savings. And I'm very proud of that. $200 million of recurrent EBIT savings in the first year of a transformation, and $500 million of the working capital is a great start. If I focus a little bit on the EBIT side, so last year we mentioned we had basically 3 levers that we could attack as part of our operational transformation. The first lever was a direct cost lever. This is a bucket of about $14 billion on average of cost that is driven by what goes on to our products, what we buy from our vendors, and the value added we put in. We have a second lever, which we call indirect cost, which is basically a lever of about $4 billion annually. And this is the administrative costs of all the administrative functions in the company, SG&A type of functions, as well as the goods and services that we procure as a company. So if you look at our $200 million worth of EBIT, it really was driven basically 2/3 coming from the direct cost lever and 1/3 from the indirect cost lever. Now, we've aligned the company under 6 work streams against these cost levers that we've named them in very simple terms. So under direct cost, we have the cost levers of manufacturing efficiency, manufacturing footprint, and supplier BOM. And on the indirect cost side, we have the 3 levers of administrative efficiency, indirect goods and services, and our global work share centers. So the entire company has aligned its EBIT cost reduction initiatives against the 6 work streams. So if I take our $200 million that we got this year and I look forward towards 2020, what do we see? First, we had mentioned that in 2020, the transformation was going to deliver about 300 basis points to the overall EBIT plan of the company. So about $750 million of 2020 EBIT is coming from our operational transformation. So if you look at it, the $200 million that we got this year gives us another $600-odd million of EBIT to go get in the next 4 years. About $400 to $500 million of that EBIT is currently in execution. And it's in execution against the 4 work streams that really impact the way we do work at Bombardier. That's our manufacturing efficiency, our administrative efficiency, our manufacturing footprint, and our global work share centers. These 4 work streams are going to deliver another $400 to $500 million in the next few years. Nico will come up and talk to you in a few minutes about the other 2 work streams, our supplier BOM and our indirect goods and services, that round us out to the over $750 million. Let me take a few minutes and let's dig a little deeper into this $400 to $500 million. Where's it coming from? As you guys know, in 2016, we announced 2 restructuring events. one in February and one in October. This restructuring impacted over 14,000 positions in the company, and it was in direct support of these 4 work streams, really in direct support of restructuring the way we do work. These restructuring announcements total $500 to $600 million worth of savings by the end of 2018. Now, why do I say that we're in motion already? Because $100 million of the $500 to $600 million has already been delivered in 2016. So $100 million of the $200 million that we delivered in 2016 has been supported by this restructuring initiative. So we have another $400 to $500 million to go. Gives me a lot of confidence because our teams know how to do it. They've already started, and they're delivering results. This has a great impact on the company. First, if you look at the dotted line behind me on the graphic, what you see is basically the output per FTE going up between 2015 and 2020. To be expected, right? We're growing from $16 billion to over $20 billion, $25 billion as a company. You expect our output per FTE to go up. What the structural changes that we're doing is also having as an effect is it's taking the average cost per FTE during this time frame down by 5%. And that's really powerful, right? We're growing as a company, but our average cost per FTE is coming down during the same time frame. Now you may say, Jim, how are you guys doing this? How are you growing 1-to-1 book-to-bill ratio at BT, the C-Series ramping up, the Global 7 coming in, innovation, and still taking your costs down? Well, what you have to understand is what our work streams discovered during our bottom-up analysis and the work we've done in 2016 is we had a lot of redundancy in the system at Bombardier. We had a lot of things being done in a lot of places that were very similar across the network. In fact, I've had the pleasure of visiting many of our plants across the last year that I've been on the job. And I tell you, I call many of them the jack-of-all-trade plants. We did everything from make a fastener all the way to assemble a final product. Clearly, not the most efficient way of doing things. So what are we talking about here? We're talking about site specialization. We're talking about creating centers of excellence, where we take our best processes, surround it with our people, and give a site a global mandate to deliver that good or service around the globe. And it's this fundamental structural change that gives me a lot of confidence that A, we're going to get these financial results, and B, we're actually changing the way the company works. Perhaps let me give you 2 examples to help you understand this a little easier. I'll start with Belfast. Belfast was already a center of excellence for complex composites. It makes the most complex composite we have in the company, the C-Series wing. What are we doing at Belfast? We're building on the center of excellence, and we're basically making Belfast a center of excellence for aerostructure systems. Whether they're composite or metallic, it doesn't matter. Belfast will deliver to BBA and BCA complex aerostructure systems. The simple component parts, they go out to other facilities in that network that specialize on making component parts. This example at Belfast doesn't only apply to aerospace. We're also spreading across all of BT. And also, centers of excellence aren't limited to manufacturing. Laurent will come up in the next session, and he'll talk to you about a centers of excellence that we're creating at BT around an administrative function, engineering. So at BT, we're creating centers of excellence where we're putting our engineers surrounded by cross-functional team in a location, and their mandate will be to deliver a specific product. For example, a locomotive or a double-decker. What this allows us to do is take bids coming in from around the globe, combine them with the basic fundamental building blocks of, let's say, a double-decker that we've already designed, merge the 2 together, give the customer a product that meets their requirements, but allows us on the internal side to gain the efficiency of our designs, and on the manufacturing side to gain the efficiency of reproducing the fundamental building blocks over and over again. So I've covered with you guys the 4 work streams that are delivering against our EBIT goal for 2020, which is really all around restructuring the company. I'm going to pass the baton on to Nico now, who will talk to you about the other 2 work streams, the supplier BOM work stream and the indirect goods and services work stream. This is how we're working with our partners so they can bring value to our transformation.
Thanks, Jim. Well, good morning also from my side. Looking at all the activities which we have been doing, I think you have seen in John's presentation and Jim's presentation, there's no single solution to everything. So it's a team approach which we have been embarking on. So let me look on the direct product cost. We have on that chart, you have aerospace and transportation. Let me focus on a couple of things in here. Like our target is we want to get more than 200 basis points out of that. For the direct product cost, just as a small reminder, that's about $14 billion. We have been working closely with all our vendors, and during the course of the year, we have delivered unit reductions, which provide even greater impact as we go along for the following years. And one of the things is also a book-to-bill ratio in BT, which is about 1.1. We talked about the C-Series ramp-up, which will have a significant impact. That's on the chart, is growing the new programs and leveraging scale. And we have the Global 7000 coming into production because flight test has started. In addition, one of the things which changed compared to the previous Bombardier is really we grouped all the procurement into one organization. So our ability to speak with one voice to all the suppliers actually does significantly allow us to negotiate win-win relationships when we leverage 14 billion of total spend rather of working as 4 small companies. On the aerospace side, we also have introduced key account leaders who are single Bombardier voices and contacts to our suppliers. So everything which happens with that supplier goes through one. You would say this is state of the art. It wasn't. We have introduced that. It's working. We have now established those. And we also can, with this, have a strategy with each of those suppliers. On the BT side, our business was fragmented. Like there was every village had the procurement team, had every system duplicated. Jim elaborated on that on the footprint side. Now we have one region, one supply-based contract area. And if you look at the suppliers, on the chart it says 10,000. We're going down to 2,000 around in 2020. We have come last year from 30,000 suppliers. And this is really making our system more efficient. It creates more win-win. It brings our costs down. Our spend with the top 100 suppliers today was only, or last year, was 60%. We will grow that significantly in order to have, again, more efficiencies, more scale. If I look at, yeah, we're still on the right chart. We're consolidating the spend, therefore, with a smaller group of suppliers who are becoming our partners and therefore have more incentive also to work on win-win solutions with us. This is one of the things, because some of you asked me last year, how do you do it? You shrink some part of the business, and how do you want to get cost out? Well, we have found suppliers with whom we want to work. We are significantly pushing them up, and therefore they have a winning proposition for themselves as well. If I look at indirect goods and services spend, for many people, a black box. It's not a black box. Yes, it's $2 billion, but we know pretty well what it is. We have analyzed it. We leverage our global workshare sites to manage demand coming from all the entities. And this ensures a minimum leakage, and it maximizes compliance. And consolidating the procurement teams, again, into one procurement team for aerospace and transportation, we have one global leader, and we're able to negotiate true global contracts. Again, one of the things, leveraging scale. As an example of our efforts, just pick one, and it sprang into mind. It includes waste management, cleaning, landscaping, snow removal, etc. If we just look at Montreal alone, we're at about 500 different suppliers. Leave alone just managing 500 suppliers, which takes a ton of people. It was not the most efficient way, and we probably employed everybody who would offer those services. Right now, we are consolidating that into one supplier who has some sub-suppliers. This is resulting in overall savings in a double-digit percentage area. This is just one example of how that consolidation actually helps. And remember, we came from a highly decentralized world. And that really means each region, each business unit, and the subunits managed their own indirect spend with no correlation to each other. Right now, we know we can have these actions, which I just described and you see on the chart, will help us to get at least 100 basis points down in terms of the cost or expand our margin. And that is just a short summary of what we're doing, in addition to everything which the business units do, what Jim is doing on the transformation. And with that, I think I'll pass back to Jim.
Thank you, Nico. So over the course of the last 15 minutes or so, Nico and I, we talked to you about basically the 6 work streams that are driving the EBIT portion of our cost reductions and our free cash flow. Allow me to talk to you over the next couple of minutes about the working capital side, because it's equally important. If you want to understand working capital at Bombardier, it's very simple. It's inventory plus accounts payable and accounts receivable, those 3 buckets. Together, those 3 buckets are around $13 billion on average per year. As we look at this complete working capital bucket, one thing clearly stood out to us. It's that the WIP, the work in process, the inventory that we have in our final assembly lines is 70% of the total working capital bucket. So guess where we started to attack? We started really to attack the WIP, the work in process in our final assembly lines, because this was the biggest opportunity we had. And I'm going to illustrate what we're doing in a very simple example to make it clear. So if you look at the top of the graphic behind me, you just see a very simplified aircraft assembly line. It consists of different stations, in this case, 5 stations. So the first station, you got the tail and the fuselage that come together. The operators do that. Then you move to the next station, you install the wings that you see in orange. Then you move to the next station, you install the engine, so on and so forth. That kind of gives you an inventory cycle following the gray curve. So as you add more value added to your finished product, your inventory goes up, right? Now, what did we learn? And we really drew upon centers of excellence that we have in Darby on the rail side and in Mirabel on our commercial aircraft side. We learned fundamentally 3 things that we're applying to our assembly lines going forward and retrofitting to the existing assembly lines. The first thing we learned is that when you get your engineers and your operations people to work together in designing a product, you actually could design a product that doesn't take as many steps to assemble. It comes together easier, so to say. So in this example, on the second line, marked revised, what you see is an elimination of 1 station. Obviously, if you eliminate 1 station, you kind of shorten the time your money's out there per unit on inventory. So you start building inventory following the blue line on the graphic. Second thing we learned is our engineers working together with our supply chain providers can also design major subsystems. In the case of a plane, we're talking about wings and engines, which are high-cost subsystems. They can be designed and tested to come into your assembly line later on, the so-called plug-and-play model. So you don't have to install them early in your assembly line. You can install them later. So that kind of shifts the profile of your inventory dollars. It shifts them closer to the point of delivery. And the third thing we learned is when our procurement teams work with our suppliers, explain our inventory build cycle, well, then we get into things like consignment, which has our suppliers supporting the inventory cycle, and payment terms, which has a working capital effect. Those 3 things, and the implementation of those 3 things against our assembly lines is what liberated $500 million worth of free cash flow in 2016. And we're going to continue to exercise this as we go forward. What's really important to understand is the end goal here is we're a growing company, right? We're growing from 16 to over $25 billion. And what we're trying to do is take down our inventory, manage it basically within a bucket of dollars that's pretty much equivalent to where we're going to be at the end of 2017. This will naturally give us about a half-point lift in turns for the company as we go towards 2020. So in conclusion, our transformation is in full motion. All 4 of our business segments are delivering results. As I look forward to the next 2 years, it's really all about 3 simple things. Continuing our journey on our centers of excellence and completing it, making sure that Nico and the team continue to build the momentum on the supplier BOM side, and applying all the learnings on our work in process so we can liberate the free cash. And with that, I'll pass it over to Patrick, and I think we're ready for a Q&A period.